Let's talk about stocks, money, cronyism, shorting. We'll begin with talking about Gamestop, Reddit, and Melvin. Shares in Gamestop have been low, like under $10 each low, for a long time. The company has had problems. Enter the big hedge fund groups, especially Melvin. They figure they can short the stock, destroy GameStop, and make a profit doing it. In fact, they targeted other companies too. What does it mean to short a stock? Rather than buying a stock, waiting for its value to increase, then selling, you win by having the stock lose value. How? First, you borrow stock from a broker. You don't buy anything. You just borrow with a promise to return. You then sell the large quantity of stock, which you don't actually have, but you're still allowed to sell it because banks and governments say it's okay. Well, you're not allowed to. I'm not allowed to. Only big banks, investment companies, hedge funds, etc. are allowed to do it because they trust each other to return the shares. They don't trust you or me, so we don't get to play. Now, notice the key difference between shorting and simply driving down a stock by selling. The latter requires first owning the stock, then selling it, and the price will resultantly go down. That's normal market behavior. You sell what you own, and if more sell than buy, the price goes down. Likewise, you buy things, and the more who buy, the price goes up. Now, back to shorting. You drive down the price by selling shares you don't own. Then, when it's gone down enough, you buy them back. You return the borrowed shares and pocket the profit. The only risk to you is if the price actually goes up while you're shorting. That's what happened with GameStop. Some people noticed what Melvin was doing and decided to reverse the trend, make Melvin owe instead of gain. Thousands upon thousands of people put in for whole or partial shares, so the price kept going up. When time came for Melvin to return what was borrowed, Melvin had to buy at a much higher price and lost billions of dollars. Now remember, without these people voluntarily putting up their own money to buy stock, Melvin's move would have driven the price down, possibly ended the company, and cost anyone who actually did own stock in it. They're okay with that. Do it all the time. But people taking their move out from under them, costing them money, that's bad. See, Melvin is allowed to profit by hurting others, but others aren't allowed to profit by hurting Melvin. You see how this works now? As the push to buy gained attention, more people joined in. Sure, Melvin may have been one of the funds in your grandma's 401k, but don't worry. Other funds simply loaned Melvin money to keep it going. Would they have loaned this money to GameStop? To anyone who lost money because of Melvin shorting GameStop? It gets better. Now, we'll talk about naked shorting. No, it's not the same as pantsing someone. We're still talking about investments. What is naked shorting? Well, part of borrowing shares in order to short them requires verification of the existence and ownership of those shares. Naked shorting is shorting and selling more shares than can be verified as even existing, much less owned. Isn't that illegal? It is, actually, but only since barely over a decade ago. Great. So it can't happen. Why mention it? Because it can happen. It does happen. It's what did happen with GameStop. It's why Melvin drew so much attention and ire. So they'll be punished for doing it, right? Nope. See, the inefficiencies in these market transactions create time lags in being able to verify the shares. Think of it like being watched by regulators. Then you slip into a wormhole or pocket universe or something and come out at the end having already completed your deal before the regulators could verify your shares. It's not your fault. It's the lag. you found a legal loophole. Now, feel free to blame lawyers for this one too. Much like big investors, they have a big hand in this win at any cost, look for ways to get around the law mentality too. And yet, the big money, with their government cronies who let them do this, are crying foul and insisting these thousands of individuals are guilty of market manipulation for literally doing what stock trading is meant to do. Buy it and see the price go up. Shorting isn't manipulation. That's just something they do. But legions of individuals buying and driving up the price, that's somehow bad. Big money? Privileged. Government? Privileged. You and me? Guilty for trying to play by the rules because this time some actually were able to win within the system. I wouldn't even touch the whole Robinhood volatility purchase limit fiasco. That's its own secondary nightmare to this one. So, Senator Warren of Massachusetts wants more regulation, even going so far as to suggest that big money funds played both sides of the GameStop drive. That's how she justifies calling it all manipulation. When was the last time more regulations helped people on the bottom of the economic scale? As with any industry, regulations amount to do this thing or pay this fine. As often as not, the large players simply pay the fine and keep doing what they do. Meanwhile, market entry is further restricted for people who can neither meet the new regulations nor pay the fines. Market self-regulation, when allowed to work, follows the interests of the majority of the people by rewarding the best in the market and withholding from the worst. Government regulation more often keeps the already large and already connected worst players alive. In fact, they're usually the ones not just calling for regulation, but helping to draft it too. Wait, that's what Melvin and the other funds want. Huh, crazy. But isn't Senator Warren all about fairness? Yes and no. We'll get to that another time.